Welcome to the Deep Dive, your shortcut to being well-informed.
We unpack the key insights so you don't have to wade through it all.
And today we are diving deep into SanDisk's fourth quarter fiscal year 2025 earnings call. This went down yesterday, August 14th, after the bell.
Right, and it's a really important one. SanDisk, being a pure-play flash memory company, gives us a pretty clear signal about the whole memory market.
Especially with everything going on with AI storage demands. So we're going to get into the results, the strategy, and maybe some of that interesting market reaction.
Definitely. There's a lot beneath the surface here.
Okay, so let's start with the headlines. The Q4 FY2025 results. How did they actually do?
Well, on the face of it, very strong. They beat expectations pretty handily on both revenue and earnings.
Okay, specifics.
Non-GAAP EPS came in at 0.29 cents. That was definitely better than the consensus estimate.
And the top line.
Revenue hit $1.901 billion. Again, comfortably ahead of what analysts were predicting.
And crucially, gross margin.
Showed improvement. Non-GAAP gross margin landed at 26.4%, which was up from the previous quarter.
So good numbers, positive guidance for next quarter. Sounds great. Right.
You'd think so. Management sounded quite optimistic, but the market reaction was, well, cautious is maybe putting it mildly.
Right. The stock actually dropped in after hours and pre-market trading.
Exactly. A significant decline. It looks like a classic, sell the news situation maybe, or perhaps investors digging deeper into the details.
That's what we need to do then. Let's dig into those Q4 financials first. That $1.901 billion revenue, where did that growth come from?
It was solid growth, up 12% quarter over quarter, 8% year over year. And interestingly, it wasn't just volume. It was driven by mid-single-digit increases in both bit shipments and average selling prices, ASPs.
Okay, so they shipped more and they got paid more for it. That suggests a pretty healthy demand environment, right?
Definitely points towards demand outpacing supply, giving them some pricing power.
Now, that gross margin figure, 26.4%, you said it improved, but tell us more about what's in that number.
Right. This is key to understanding the market reaction, I think. That 26.4% included some pretty hefty charges.
Like what?
$51 million in underutilization charges, basically costs for fabs not running full tilt yet, and another $42 million in FAB startup costs, getting new facilities ready.
Okay, so temporary costs related to ramping up production.
Exactly. If you actually strip those out, the gross margin would have been more like 31.3%.
So the underlying profitability is quite a bit stronger than the headline numbers suggest.
Precisely. It hints at the potential once these temporary costs start to fade.
And it seems like they're managing the balance sheet well, too. I saw something about debt reduction.
Yeah, they made good progress there. Reduced net debt down to about $368 million. They're actually aiming to get to a net cash positive position.
That's disciplined. What about inventory?
Also improved. Inventory days dropped from 150 down to 135, shows better management and likely strong demand pulling that inventory through.
And cash flow.
Generated $77 million in adjusted free cash flow for the quarter. So financially, things seem to be moving in the right direction operationally.
Okay, so that paints the Q4 picture. Now, what about the outlook? The guidance for Q1 fiscal 2026.
This is where management sounded particularly bullish. They guided Q1 revenue to between $2.1 billion and $2.2 billion.
Wow, that's a significant step up sequentially.
It is. And non-GAAP EPS is projected between $0.70 and $0.90, a big jump from the $0.29 in Q4.
Huge jump. And the gross margin continuing to climb.
Yep, targeted at 28.5% to 29.5%. So another sequential expansion. And they said that's mainly driven by higher pricing.
But critically, does that still include those FAB costs?
It does. This is important. That Q1 margin guidance includes roughly $60 million in FAB startup costs and maybe $10–15 million in underutilization charges.
Okay, so still headwinds in Q1.
Right.
But did they give a timeline for when those ease up?
They did, very explicitly. They expect those FAB startup costs to reduce significantly in Q2 and become minimal by Q3 of fiscal 26.
And underutilization.
Expected to approach zero after Q1. So the path they laid out shows these costs really falling off sharply over the next couple of quarters.
That's a very clear roadmap for margin improvement then, assuming they execute.
Absolutely. They also expect positive free cash flow to continue in Q1 and net debt to keep declining.
Okay, so the financials, despite maybe some near-term cost noise the market reacted to, seem pointed firmly up based on guidance of the cost roadmap. Let's shift to strategy and market dynamics. What's their view on the overall flash market?
They doubled down on the view that demand exceeded supply in Q4, and more importantly, they see that undersupply situation continuing right through calendar year 2026.
Through all of 2026, that's a strong call.
It is. They quantified it as a mid-single-digit undersupply for fiscal 2026. If that holds, it obviously supports continued strong pricing and margin expansion for the industry.
A rising tide, potentially. How is SanDisk positioning itself strategically to capture that? Let's talk tech, the BiCS8 node.
Right, that's their next-gen manufacturing tech. It's absolutely pivotal. It's set to become their main node in fiscal 26.
Where is it now in terms of production mix?
It was about 7% of bits shipped in Q4, but they expect that to ramp to 40–50% by the end of fiscal year 2026.
That's a big shift. What does that mean for costs?
Well, near term, ramping a new node like this means higher capital intensity and maybe slower cost reduction initially, working out the kinks, getting yields up.
The upfront investment, basically.
Exactly. But as BiCS8 becomes a larger portion of the mix, it should become a major tailwind for cost reduction. It's designed to be much more efficient.
So short-term cost pressure for longer-term cost advantage.
Yeah.
Makes sense. What about other tech? I heard about high-bandwidth flash, HBF.
Yeah, this is exciting. They unveiled HBF technology, aiming it squarely at high-performance AI storage needs. It even won a Best of Show at the Flash Memory Summit.
High praise. What's the strategy there?
Key move. They're collaborating with SK Hynix to standardize the HBF specifications.
Trying to build an ecosystem, not just a product. Smart.
That's the idea. They believe standardization is crucial for adoption everywhere from PCs and phones at the edge right up to cloud AI inference servers.
When can we expect to see HBF products?
General availability is targeted for the second half of calendar 2026, with samples, including the controller, hopefully in the first half of 2027. So still a little ways out, but a clear long-term bet.
And tied into that AI theme, the Ultra QLC platform.
Right, they showcase that too. QLC, quad-level cell, packs more data per cell. They demonstrated a massive 256 terabyte enterprise SSD using this Ultra QLC tech.
256 terabytes. Who needs that much capacity?
Think AI training, massive data lakes. The demand in the data center is exploding. This platform is targeting exactly that huge capacity density for enterprise SSDs.
How big is their data center business now?
It represented over 12% of their total bits shipped in Q4, and they're pushing hard here. They mentioned progressing qualifications with a second major hyperscaler, think Google, Amazon, Microsoft, and others, using Nvidia's GB300 AI platform.
So trying to get design into those big AI infrastructure builds.
Exactly. The goal is to get this Ultra QLC platform qualified at several big Tier 1 customers by the end of fiscal 26. That could unlock serious revenue.
Okay, that covers the high-end AI stuff.
Yeah.
What about the more traditional client and consumer markets? PCs, mobile.
They noted pretty consistent demand signals there. Inventories seem normalized, which is good.
People still buying phones and laptops back.
And needing more storage in them. They expect average capacity per smartphone to be up high single digits this year, even more in 2026. PCs up mid-single digits this year, moving towards mid to high single digits next year.
Steady growth.
Right.
Are they doing anything specific in consumer branding?
Yeah, continuing to innovate. Mentioned new USB 4 portable SSDs, faster speeds there, and some gaming collaborations too, like a microSD Express card co-branded for the Nintendo Switch 2, and an expansion card for Xbox, smart niche plays.
Okay, and quickly, any comments on competition or those pesky tariffs?
On competition, they basically said they factor everyone into their forecasts, standard procedure. For tariffs, specifically the Section 232 ones, they said they're monitoring closely but are confident in their ability to navigate the global situation. Sounds like they have mitigation plans.
Okay, so let's tie this all together for the investor context. We have strong results, strong guidance, a clear cost reduction roadmap, yet the stock sold off. Why the disconnect?
It seems investors are really zeroed in on the near-term gross margin trajectory, that GM cadence, as they call it.
They're focused on the Q1 headwinds from those FAB costs, basically, and maybe questioning how durable this flash-up cycle really is.
I think that's fair. They want to see the proof that those costs are fading as quickly as guided and that the BiCS8 ramp delivers the cost benefits promised. There's maybe some show-me sentiment.
While management is painting a picture where those headwinds clearly turn into tailwinds over the next few quarters.
Exactly. They see the temporary costs rolling off just as the more efficient BiCS8 node takes over, all happening within an industry environment where demand is expected to outstrip supply. It's a potentially powerful combination if it plays out.
So the key things to watch going forward would be?
Actual gross margin numbers versus guidance each quarter, updates on BICS8 yields and mix percentage, any news on HBF partners or milestones, big enterprise SSD design wins, especially with those hyperscalers, and of course just broader memory pricing trends confirming that undersupply story.
Those are the data points that could shift sentiment.
Right, which brings us nicely to, well, a thought experiment.
Okay, let's do it.
Yeah.
And let me preface this. This is absolutely not financial advice. We're just exploring possibilities based on the call.
Definitely not advice, but here's let's call it an outrageous but plausible trade idea for SanDisk, ticker SNDK.
Intriguing. Go on.
We're dubbing it the headwind to tailwind long play. The core idea is that the market seems overly fixated on those Q1 FY2026 gross margin headwinds, the $60 million in FAB costs, etc.
Which, as we discussed, are guided to drop significantly in Q2 and become minimal by Q3.
Precisely. At the same time, BICS8 is ramping from just 7% of bits now to potentially 40-50% by the end of fiscal 26, becoming a major tailwind for cost reduction.
So the trade is betting that the market eventually shifts focus from the near-term temporary pain to the longer-term structural gain.
Exactly. The play might be something like a long position, maybe using longer-dated call options or a synthetic long, targeting an expiration out in late fiscal 2026 or early fiscal 2027, say December 26 or March 27 calls.
Giving time for those costs to fully roll off and for BICS8 to really demonstrate its cost benefits in the reported numbers.
Right. You're betting on that operational leverage becoming undeniable, combined with the ongoing industry undersupply. The thesis is that as the evidence mounts, the stock could see a significant upward re-rating as the market catches up to the improving reality.
Waiting for that sentiment shift as the headwinds literally become tailwinds on the P&L. Okay, interesting thought experiment.
Again, purely hypothetical, high risk, potentially high reward if the thesis plays out.
Understood. So to wrap up our deep dives today, SanDisk delivered strong Q4 numbers, offered confident guidance, and laid out a strategic path leveraging new tech like BICS8, HBF, and Ultra QLC, especially for AI.
But the immediate market reaction was cautious, focused on those near-term margin headwinds from capacity investments. Management, however, presented a clear plan for how those headwinds should dissipate and turn positive.
So the big question for you, our listener, is, will SanDisk's execution on its technology roadmap and cost management, combined with favorable market dynamics, be enough to overcome the market's current caution and unlock that potential value?
Watching their execution, particularly on margins and the BICS8 ramp over the next few quarters, will be absolutely fascinating.